Our next guest says that staying diversified in your portfolio will help ride the waves of potential policy changes in the coming year. For more, we're joined by James Learmonth, a senior portfolio manager at Harvest ETF. Hi, James. How are you?
Great, thanks. Great to be here.
Let's just look back a little bit, 24 hours if we could, or a little bit more than that, but to the economic data out of the United States, and then today's as well. So CPI accelerating a little bit, but the core pulls back. Then you had retail sales, a little light today, jobless claims a little more than expected. Can you give us a little roundup there?
Sure. I mean, we're generally optimistic about U.S. equity markets as we move through 2025. There's certainly a tremendous amount of uncertainty as we look through the year, particularly with regards to economic policy. But we also know that there's potential for a pretty significant difference between political rhetoric and actual policy that gets implemented. And so during these times of uncertainty, I've found over the course of my career that the best thing to do is to just keep it simple and go back to basics and look at fundamentals. And so when we look at the economy generally in the U.S., what we're seeing is continued evidence that the Fed has managed to successfully engineer a soft landing there. From a labor market perspective, we've seen the jobs market cool pretty significantly from the very heated pace that we saw during the reopening period post-pandemic. But when we look back historically, job growth is actually relatively healthy in that context, and we've seen even some signs of stabilization there over the past several months. As you mentioned with inflation, kind of a similar story. We've seen inflation levels fall from the very high levels we saw immediately following the reopening and through the major supply disruptions during the pandemic. But pardon me, and although we're still above that 2% target for the Fed, we're steadily moving towards that target, and we think we'll continue to move in that direction, even though the pace of disinflation has slowed a little bit over the past few months. When we look at corporate earnings, what we're actually seeing is analyst expectations reflecting a reacceleration of earnings growth as we move through this year. And so we think that will ultimately translate into better breadth for the markets. And that's really where that importance of having a diversified portfolio comes into play as we sort of transition into this more of a rising tide environment for the market.
And James, a lot of people cite the historically high valuations for stocks, but do you believe that earnings ultimately will justify some of these valuations?
I think for some of them they will, but we've seen a couple of years for the S&P 500 now back-to-back 20% plus returns. And I don't think it's news to anyone that those returns have been pretty heavily skewed by sort of the Mag 7, if you will, group of companies. And while equally weighted indexes have also gone up during that time, they've lagged pretty significantly. And I think from a valuation perspective, what we expect to see here is kind of a slowdown in earnings growth, although still healthy earnings growth for those giant tech leaders. But that reacceleration and improving breadth for earnings growth across the rest of the market has the potential to sort of drag along and bring up the rest of the market, which ultimately makes, I think, for a much healthier market environment.
Okay, James, you've got three names for us here, and then you've got a bit of a theme running. Let's roll through them. We've got Eaton, RTX, and JP Morgan. We'll start with Eaton. Big market cap here, $138 billion, power equipment.
Yeah, so maybe I'll just take a little bit of a step back there. So a couple of the areas that we really like going into 2025 are the industrial sector and the banks in the U.S. So for the industrial sector, we kind of distill sort of some of the longer term, intermediate and longer term drivers that we see into the three R's. So economic recovery, which we talked about, reshoring, which has been a theme that really took hold during the pandemic with all the disruption in global supply chains. But obviously the incoming Trump administration also laser focused on driving that reshoring of manufacturing back into the U.S. And then rebuilding, which we've had a few different bills put in place, most notably the Investment Act, Infrastructure and Investment in Jobs Act in the U.S. that was signed into law in 2021 to drive some additional funding, about $1.2 trillion worth of funding into roads and bridges and rail infrastructure in the U.S. But on top of that, we've got longer-term drivers such as the build-out of AI-focused data centers, as well as electrification and the growth of electric vehicles. So within that context, we think Eaton Corporation is really well positioned to take advantage of those themes. They're a provider of intelligent power management solution products and electrical components. And so they're already benefiting from the pretty significant build out that we've seen in data centers already, as well as they have business lines that are leveraged to the adoption of electric vehicles. They even have some exposure to the utility space and manufacturing. And so as these increased electricity requirements come to bear over the coming years with build outs centers and electrification, they've got business lines that are really focused on being able to take advantage of that.